How does transitory versus persistent inflation impact commodity markets? Imagine walking into a store and seeing prices jump suddenly. Now picture those prices staying high for years. What causes these shifts, and how do they affect commodities like oil, gold, or food? That's what we're here to find out. When inflation is transitory, it means prices are rising for a short time because of temporary issues. Think supply chain hiccups or a sudden surge in demand. For example, during a pandemic, oil prices might spike because of shipping delays or limited production. Once those problems clear up, prices usually fall back down. Investors see these quick jumps as chances to buy low and sell high, but don't expect long-term gains. Transitory inflation makes commodity prices jump sharply but then stabilize or decline as the situation improves. It also causes more price swings, making the market more unpredictable in the short term. Persistent inflation is different. It lasts longer and is driven by ongoing economic factors. For example, if wages keep rising or if there are continuous shortages of raw materials, prices tend to stay high. This kind of inflation pushes commodity prices up over months or even years. Investors often turn to commodities like gold or agricultural products to protect their money from losing value. When inflation sticks around, it can lift prices across many commodity sectors, encouraging more investment in these markets. Knowing whether inflation is transitory or persistent helps investors decide how long to hold onto commodities. If it's transitory, they might focus on quick trades or avoid overcommitting. But if inflation looks like it will last, commodities can be a good way to keep up with rising prices and protect savings. Persistent inflation also makes central banks tighten monetary policy, which can raise borrowing costs and slow economic growth. This can affect demand for commodities, especially those that need a lot of investment to produce. On the other hand, transitory inflation often leads to a wait-and-see approach from policymakers, letting prices adjust naturally. In the end, short-term inflation causes quick price spikes that may reverse, while long-term inflation supports higher prices over time. Investors need to watch economic signals closely to understand which type is happening and plan their commodity investments accordingly. This way, they can better protect their money and take advantage of market trends.